Welcome back to the final round. Well, UBS out with a note saying that there's a clear argument to be made about the strength of the economic rebound, but it's also warning that there's many headwinds that still remain. So joining us now on the phone, we have Seth Carpenter. He's a Chief U.S. Economist at UBS. And Seth, it's great to talk to you again. In a recent note, I was going through some of the things that you said, but you led with the fact that we still have a gridlocked Congress, a hesitant Fed, and slowing growth. So how are you looking at the recent data that we've gotten and some of those challenges that still lie ahead with no stimulus over the next couple of months?
Yeah, I think obviously key is going to be Friday with the jobs report. We're looking for 1.2 million private payrolls. I'm old enough to remember when that would be considered a great payrolls number. I think anybody older than 7 months old can remember that. But it's way down from where we were in May and June with the big rebound. And so what we're seeing is this moderation in the expansion. So we bounced off the bottom strong. We're still seeing sort of positive growth, but it's not super strong. I think the lack of another fiscal package is going to weigh on things. I don't think it's enough to tip us into outright contraction again in Q4 because you still have a lot of households whose spending is depressed, whose savings rate is high. And so we should still continue to slowly grind higher. But a lot of that momentum from the big bounce, I think, is wearing off.
Yeah, so that's interesting because when you take a look at some of the housing and consumption numbers that you went through in your note, we see those areas of the economy rebounding quickly. But to what degree do you think it can offset some of the weakness that we're seeing in the services sector, for instance?
Yeah, I mean, so services is going to be key. It's a big employer. And remember, we're still down about 11.5 million payrolls from pre-COVID levels. And it's that kind of spending that's being done by, the middle and upper income people, the ones who didn't actually, in general, lose their jobs. That has to come back, and that will sort of restore some of the employment, which gets you that virtuous cycle. Right now, spending on goods, back to pre-COVID levels, if anything, a little bit higher. And a non-trivial chunk of that is online sales or curbside pickup. We're also seeing, as you said, the housing sector, that's actually doing quite well. Record low interest rates, it turns out, really helps. And people are trying to do some of that purchasing. But that bulk of the economy, so 70% of the economy is consumer spending. 70% of that 70, so roughly half of the overall economy is the services spending. And that's the part we really need to see come back so we have a sustainable, self-reinforcing cycle.
Hey, Seth, Rick Newman here. Can you tell us how much you're seeing in terms of business closures that are going from temporary to permanent and job losses that are doing the same thing, going temporary to permanent? And just how lasting do you think this damage is likely to be?
Yeah, so I think therein lies one of the big challenges. We are seeing lots of business closures. I think we'll get another read on that for the labor market on Friday. We knew in the first couple of months, a large share of the people who were unemployed were classified themselves or were classified as temporary. For me, what's going to be as important as any of that is going to be looking at this labor force participation rate. So it fell a huge amount, and we always see a bit of a cyclical downturn. If we can't get a recovery back up past 62%, closer to 63% where we were before the pandemic, that's going to be a reflection of, in my view, more lasting scarring of the labor market. And that's the kind of thing that lasts for a long time. In the last cycle, right, labor force participation among prime age workers, so 25 to 54-year-olds, it literally fell from 2008 all the way to 2015. And then it took another 5 years after that to recover those losses. And so we're talking about something that's a very slow moving part of the economy. And it's part of what could be, real scarring mechanism from this downturn.
Hi, Seth. This is Emily. Just taking a look at the areas of the economy that haven't completed that V-shaped recovery. So basically anything outside of the housing market and retail sales. At this point, do we just continue to see deceleration in absence of fiscal stimulus / a vaccine? Or is there a point, given the trajectory that we're on, where growth actually turns negative in some of these areas?
Yeah, so we can't rule out negative. It's not our base case at all, but I don't think we can rule it out. And one of the reasons is the part of spending that's depressed, like we were saying, was on services. And at least in the data historically, there's a relationship between how much people spend and their income and their wealth and all of that. And right now, that spending is actually well below the relationship you'd expect with the income, even with getting rid of the fiscal package. And so there should be some of that recovery, that sort of mean reversion as people get more and more used to working from home, as people get more and more used to living in this pandemic environment. We should still see some buoying in level terms back up of spending. But I don't think it would take all that much to tip it over to negative without fiscal, but with sort of COVID staying roughly moderate where it is. We're looking for 2-ish% growth in Q4. If this potential second wave that's brewing now, if that becomes truly outsized and people really pull back, that's the sort of scenario that could cause negative growth.
Hey, Seth, when you take a look at the election, just in terms of how big of an impact that could be on the economy, when you take a look at what we know from Biden's policies, comparing that to Trump, is one outcome better than the other for the U.S. economy, do you think?
Yeah, so I guess one thing I would stress, though, is Biden, Trump, clearly huge differences there across lots of different dimensions. But the other key part is that there's the congressional elections. And so I really like to think about it in terms of, do you have a unified government or do you have a split government? Because what we have seen, and we saw this in 2011 with the Budget Control Act, when you have a split government, cooperation, getting things going, more fiscal policy is often quite hard. We saw a lot of urgency earlier this year when the pandemic was raging. Now that it's calming down, like we were just discussing, the fourth package failed because there's no longer that urgency. And so I think what we really want to think about is, do you have a unified government? So if Biden wins and the Senate becomes Democrats, the Democrats control the whole of the federal government, that's a scenario for lots of extra fiscal stimulus. If Biden wins, but the Democrats don't take the Senate, or if Trump wins and the House stays Democratic, those split government scenarios, I really do think are going to matter. We're going to see much less in the way of stimulus. And so the sweep scenario is the one that's going to have the most boost to the economy.
Hey, Seth, you just mentioned the fourth fiscal stimulus package, which looks like it probably is not going to get done before the election. And there's this big gap. The Republicans are willing to do about $500 billion in additional spending, and the Democrats are going now, it looks like, for a target of $2.4 trillion, a huge gap. But wouldn't that lower number, isn't $500 billion, which is the minimum on the table now, isn't that a lot of stimulus on its own?
Yeah, no, I agree. That's a big number, no matter how you slice it. And I think the question then becomes, are they able to get even that amount in? I think the key part there, especially two components. One, the supplemental unemployment insurance benefits, because people who have lost their job in this downturn have been largely middle and lower income people who tend to consume the vast majority, if not the entirety of their paycheck. So that money going to them to support their income just gets spent directly into the economy. And then the transfers to state and local governments, that's another key component. We saw this with the last recession. State governments and a lot of local governments have balanced budget requirements. When their tax revenues fall, their spending falls. And with if the federal government can help to replace some of that, then you have less of a drag. You don't have teachers getting laid off. You don't have first responders getting laid off. So I agree with you. Even the smaller number there is a substantial amount that would go, a decent way towards cushioning the blow.
All right, Seth Carpenter, Chief U.S. Economist at UBS. Always great to have you. We'll talk to you soon.
Thank you.